Hello, welcome back to Tech Tune Up with me, your host, Paul Meeks, always brought to you by my friends at Benzinga, and also the firm in which I'm affiliated as Chief Financial Officer, Chief Investment Officer, Harvest Portfolio Management, down here in the Deep South, Charleston, South Carolina. So, in this show, we start with some tech ideas, not just to regurgitate the news, to essentially tell us what we do with those stocks, and also if there are any ripple effects. Then I will show you, as I always do, very specifically, my buy list. And sometimes I even talk about individual price limits for further purchases and sales. And then we'll end up with some tech trends. And sometimes these tech trends are not interesting only for the tech sector, but even beyond for investors, more generally speaking. And then at the end, please, please, please fire some questions my way. So first of all, let's start with AMD. AMD had a nice pop after its quarter was announced. But I will tell you, I think it was a pop based on the stock going into the print being a big tech underperformer so far in 2025, particularly against its arch rival, Nvidia, who I still think with their technology is at least ahead of AMD by 1 year or even more. But the stock was in a what we call an oversold condition. I still don't think they're out of the woods yet. Of course, I'm rooting for them because I more generally root for the entire AI infrastructure building trade. But I stick with Nvidia. Now, Nvidia is going to announce their results not until the 28th of this month. So you'll have to hold your horses on that one. The next stock is Duolingo. This is a stock that I had recommended to you in the past. A pretty good quarter, but one of the things I thought was pretty cool about their report is they mentioned that they're going to get rid of all their contractors, and they have a lot of them. In the past, they've leaned pretty heavily on contractors, and they're going to replace them with AI. So another very important AI use case, and we need more AI use cases to justify all these hundreds of billions of dollars that we're spending trading large language models. So next we have Meta. I really like their quarter. If we have a recession, both Meta and Alphabet will be dinged because in a recession, advertisers will pull back the reins on their ad spending. And of course, it's going to hit the biggest digital ad players, including Meta and Alphabet and Amazon, and even a few others, particularly social media names. But Meta's quarter otherwise was pretty clean. And going into the print, it was the only Mag 7 stock that I was defending or even buying ahead of the print. And I still feel that way with all the things that the company has going on in AI and beyond their core digital ads biz. So still feel the same way. I buy Meta on dips, and I have for some time. Microsoft with its quarter really surprised me. Microsoft had been a not only Mag 7 laggard, but a tech and market laggard ever since they had a poor quarter 90 days before. But they really surprised to the upside, not necessarily on their client business. Think about the old school software to support PC growth, but with their Azure platform, their online cloud platform. And so I was pretty impressed with their Azure growth. They continue to take a lot of share from AWS and some of the others. And so not much was expected of Microsoft, but coming out of the print, they actually outperformed. Azure growth, very strong. They also talked about reiterating their AI CapEx spend this year, which is actually a big surprise because there were rumors going into the quarterly announcement that they were delaying or canceling leases on some new data centers. So we'll see. I'm not convinced yet to take that out of my bullpen and put it on the field to be a starting pitcher, but pleasantly surprised. And I was actually pretty down on that stock going into the print. Next, we have Upwork. And, in the past, I've been asked about Upwork and Upstart. And we'll see what happens with these over time. But, I'm watching them closely now. Next, we have AppLovin. AppLovin just reported its quarter, and it had a really big bounce. And fundamentally, these guys are kicking ass. And I was worried about what they may say heading into the print. Now I feel very good about it. The stock is going to have to show some technical support, however. It's going to have to pop through that resistance at $350 a share. If it does, I actually think over the next year or so it could go all the way back to its high, which was well above $500 a share. On the downside, I probably, since I'm already in the name, I probably don't aggressively add to my position until we get back down to $300 a share and show some support there. But fundamentally, the company is doing very well. It's a situation of rising margins and accelerating revenue growth. You remember the blemish was the name back in late February when a couple of short sellers, including Muddy Waters, badmouthed the company. Not accusing it of accounting fraud, but quote unquote scammy advertising practices. Well, those short reports have been out there since the end of February. A couple of other short sellers have piled on since then. They've asked the stock exchange to investigate. They chose not to. They asked the SEC to investigate. They chose not to. And so we're just back to, despite these criticisms from the short sellers, we're back to pretty strong fundamentals. And once the short sellers cloud clears, I'm going to be very interested to see next time that they post short interest on May 15th to see how many shares were covered from the 10.8 million shares that were sold short as of April 15. Once we clear that smoke, we have one of my favorite ideas in tech, and I think they'll get through it. Next, we have Amazon. You know, their quarter was okay. I still think that they're losing quite a bit of share in Amazon Web Services. And of course, that's their most profitable business by far. They talked about so far being unscathed by the tariffs. But if you're one of the world's largest e-commerce plays, how can you not be impacted by the tariffs? You just haven't seen it yet. And one of the things that's very important for people to remember is, okay, we might have come through these quarters ended March 31 relatively unscathed, but we didn't have Trump's tariff announcements until April 2nd, and then the carnage that followed. So they really haven't seen tariff impact yet. And of course, it's going to most heavily hit the retail names, the hardware names, the semiconductor names. So Take-Two Interactive is next on my list. It continues to be on my buy list, even though the company just announced that it's going to delay the release of Grand Theft Auto 6 until May of 26. Now, it's interesting. The stock plunged on that news because it's going to be a monster hit. But what happened was the stock found support at its 50-day moving average of $213. And then it bounced off there. So you know what? I think the delay announcement damage is done. And I think we've seen the bottom in that stock. It's going to be a monster hit. I think the last time that they had a rendition of this software was back in 2013-14. So a lot of pent up demand, but a nice technical stabilization at its 50-day moving average. So I'm still bullish on Take-Two Interactive. Next on Uber. Uber dipped a little bit on its earnings. Their revenues were not significantly light, but slightly light. But I still am a supporter. I am going to buy it on stabilization. I still think rideshare, it's a hell of a better company than Lyft. And Lyft has been popping, including today recently. Lyft has a new CEO. They are increasing their stock buyback. The CEO is doing all the right things. The company had been mismanaged. And so there's a lot of low-hanging fruit that this new CEO can pick. I think as we move to the key investment thesis for this entire industry, which is autonomous driving, that Uber will again capture most of the market share from Lyft. So I see a relative buying opportunity in Uber because at least the last couple of days it's underperformed Lyft. And I think Lyft is moving very quickly to a overbought situation. So you reverse that trade, be a little contrarian here. But I do think at the end of the day, all of these EV companies are going to want to have Uber on their team, and all of these ride share customers and food delivery customers. They're not going to want to have 17 different apps. They're going to want to have one app. And I think Uber will be not 100% market share, but they will be the dominant player when that time comes. And it's just a matter of timing. It's definitely coming. So next, we have Google, right? Or Alphabet. Now, this worries me a little bit, and I concur, and you've probably read this the last couple of days. A pretty solid quarter, but what we've seen is a steady slowdown in the growth of their core digital advertising business. It looks to me like some of their share, which is essentially they've had all the share for all these years, is being whittled away by some of these AI first platforms like Perplexity. And so if you think about it, Alphabet has some cool things going on. I think Waymo and autonomous driving will be bigger than Tesla. But unfortunately, their core digital advertising revenue, which has brought them to the dance for years, is slowing. So if you own Alphabet, I'd continue to hold it. But if it has any relief bounce, I don't think that the stock is going to cost you money on the downside. But I think that perhaps owning it longer is going to be an opportunity cost when you can get some of my other better ideas in the tech sector. This is interesting. SMCI, you may recall, these guys are the data center server companies, along with Hewlett Packard Enterprises and Dell. They had a big accounting scandal and they were almost delisted, and then they came back, and their CEO, Charles Lang, said everything was kosher. And they just pre-released and then announced a poor quarter. What needs to happen at this company? Because I do think over time, the data center server business is going to remain robust. This guy, Charles Liang, he's the founder and CEO of the company. He is not trustworthy. If he really cares about the value of his company and his wealth, he should probably fire himself. Think about this. Years ago, do you remember Chipotle had the food poisoning scandal? And in the midst of that, their founder and CEO was smart enough to fire himself, brought in a hotshot from Taco Bell. That guy turned around that company. Chipotle was an awesome stock, and that guy became such a superstar at Chipotle that he was hired away to turn around Starbucks. So this is a situation where, dude, fire yourself, get somebody that Wall Street can trust, and let's move on. Apple, Apple, I continue to worry, right? I told you that unlike a lot of fanboys for Apple, and, we have the same talking heads supporting this company left, right, and center for weeks, months, and years now. Here's a company that's not growing. Revenue hasn't grown for a couple of years. The iPhone with AI on board was supposed to be a monster hit. So far, nobody gives a shit. It hasn't really driven any iPhone upgrades. And there is no large cap tech company in these United States that is going to get harder hit by the tariffs than Apple. Their manufacturing, even though they're migrating away to places like Vietnam and India, has been in China. And they've also counted on China as a growth market for demand customers. So they're in some real trouble, right? No revenue growth. Expenses going up rapidly because of these tariff and tariff-related charges. And then also, they just got dinged again by a judge who was a little bit pissed that when Apple faced a loss in the case against Epic Games a couple of years ago, Epic Games did not want to pay these egregious 30% tariffs from Apple to connect to their games for in-app purchases. Well, Apple said at that time, this was a couple of years ago, that they'd clean up their act, and they did not. And so this isn't over yet. Apple may have to, for defying the judge's orders, Apple may have to pay a big ass fine. It could get nasty. Don't think that this is going to be a quick in and out. Palantir had a good quarter, though I tell you, I'm always confounded by the valuation of this company because there were some blemishes, particularly the lack of international growth for Palantir. So the stock got whacked because it had been overbought on its report, but it's recovered since then. This is the most expensive stock in the technology sector, which means it might be the most expensive stock in the entire market. So I do like a couple things that are going on there, but unfortunately, Palantir, and I'll get into CrowdStrike next, are just too expensive for me. So CrowdStrike had a pretty good quarter, right? It's been actually a while now, but I see two warning signs, which kind of freak me out. One is in its early days, CrowdStrike was supported by Alphabet, and Alphabet had taken a big position in the shares of CrowdStrike. And recently, on this big move in CrowdStrike shares, Google sold not a little bit of its position, but almost all of it. So the people over at Alphabet are telling you that they thought that the stock was not just overvalued, but grossly overvalued. And then also, why is such a great company growing so fast like CrowdStrike making an announcement that they're going to fire 5% of their total workforce? That is a big cut in heads. So anyway, I admire the company. It seems that they got through this big scandal with their software about a year ago. The stock has come roaring back. It still is the favorite play in cybersecurity software. However, stock is really expensive. Both CrowdStrike and Palantir have shown, if you take a look at the technicals, double tops. Just think they're too expensive to buy here, and you might be able to buy them later on. Another negative tell today, unfortunately, Expedia, the travel company. Now, in this space, you may recall I always prefer booking, but Expedia announced their results, and they were pretty grisly. And no surprise, because Delta and the other airlines have announced their results, and they're talking about a pretty dramatic slowdown in business and retail travel. And no surprise, if we're going to enter a recession, which I think we will, this can't be good for these companies, right? People getting on planes, that's typically a discretionary expense. So Expedia told you today, when they really reduced their guidance, that they are being hit by all this geopolitical madness and uncertainty. Infineon is a European semiconductor company, another tell. They reported these guys are an analog semiconductor company. That means their chips are mostly in industrial applications, particularly automobiles. And they had pretty poor guidance, and why not? You should expect that, because if their chips are going into cars and trucks are going to be the most hit by tariffs, obviously they're in a bad position. And they showed it today with their guidance. This is interesting. SMIC, not to be mistaken for SMCI, the company we just talked about, but SMIC is a Chinese semiconductor company. And China doesn't have a lot of them, but this is probably the biggest one. And they also gave a pretty nasty guide. So you're starting to see maybe the tariff impact there from the other side of the world in China. Next, we have Upstart. Now, so Upstart and Upwork. Upstart is the credit company. They actually have microloans. Their stock's getting hammered on their quarterly report because they're seeing a deteriorating business. Though, interestingly, the other one that people get confused with, Upwork, that people have asked me on this program about, they actually had a good quarter. So make sure Upstart is the one that's doing badly. Upwork is the one that's doing better. I think before we go on to my list, have to talk about OpenAI. As you know, OpenAI, I've talked about it here before. OpenAI, 49% owned by Microsoft. They are trying to convert from a nonprofit entity to a profit entity, particularly since they need to raise capital and they need to someday do an IPO. And what happened was there was so much back and forth. Here's what's going to happen in the end to their structure. The holding company, the umbrella company, will still be a nonprofit entity, but they will have underneath that umbrella a for-profit segment, and that for-profit segment can continue to raise capital and maybe can even go from private to public at some point. But there are a lot of ripple effects in this with Microsoft's ownership and really a lot of the excitement in AI devolving into this weird legal situation of what is going to be the legal structure of one open AI. So next, let's take a look at my tech picks. The green names are my goes, fresh money buys. The yellow ones are in the bullpen. I'm interested, but I'm holding off for various reasons. Sometimes you'll see red. That is a stock that I could not get rid of fast enough. I punted it. Nothing here on this list. But let's take a look at the buy list, right? If we're going to build a tech portfolio today, let's focus on those, the ones that are interesting today. So I like Robinhood, Netflix. I talked about AppLovin. That has gone from my bullpen to the starting lineup. I continue to like Guidewire. I told you about Take-Two Interactive. I do like GLD, which is the gold ETF, to play a little defense. And I'm still hiding in Duke, which is electric utility. I am warming up to a couple of the enterprise resource planning software names. I think those are going to be the next beneficiaries of AI versus the hardware and semiconductor names. And here I have selected who I think are the best of the best in that group, SAP and ServiceNow. And I also like CoreWeave. Now, CoreWeave is interesting. This is a stock that I've been to since it's a private company. Now it's public. They are going to have their first public company announcement next Wednesday, May 14th. I think that they're going to upside nicely. I think they're going to reiterate a particularly aggressive growth forecast going forward. Remember, 2/3 of their revenues come from Microsoft. And Microsoft has reported, and one of the positive surprises in Microsoft's report is it's sticking with its very high capital expenditures. People thought that they might pull back on that. And of course, that would impact CoreWeave, but it looks like we're kosher there. And so the stock has done pretty well recently, though today it's getting whacked. So I would tell you, I actually think CoreWeave is a buy. Today, I saw at one point today, the stock was down 7% before the company reports next Wednesday. I'm hoping to see a relief rally, at least turning around today's action at that point. And that's not too many trading days away. So I like the drug distributors. I've been hiding there in companies like Cardinal Health and McKesson. You know this. Yeah, we'll have to see what happens. I told you already, the companies that I'm interested in that I'm just waiting on. Palantir, I want to see it dip. It's just outrageously expensive. You've heard me talk about CrowdStrike in the same vein. T-Mobile, I've backed off on because T-Mobile did have a pretty big miss in their net subscriber additions. And so we'll see what happens. Checkpoint Software, Taiwan Semiconductor, Genius Sports, all on my watch list. So next, let's get to some of the tech trends. So here we go. I love to watch rates because, believe it or not, they're really, really sensitive to the valuation of your favorite tech stocks. So it looks now that the Federal Reserve Board will not lower rates till the end of July. Now, at the beginning of this year, before Trump came into office, the conventional wisdom is that the Feds were going to raise or lower rates 5 times in 2025, 0.25% each. Now it looks like we're going to have the first rate cut, if we have one at all, essentially right before August begins. So, of course, the cross currents are the tariffs are inflationary. And if we have a recession, which I think this tariff controversy is probably going to tip us in that direction, then you actually have an erosion in the economy. And so you do have the worst of all evils, what we call stagflation. And so the Fed, like the rest of us, is going to wait and see. They meet every 6 weeks and they parse the data that is current, and they make a call. But it looks like the call that they'll next make to lower rates won't come until essentially the end of the summer. So we'll see. I'm seeing, as I've said before, some momentum in quantum. One of those old school tech companies, Cisco, kind of interesting that you would hear from them. They have developed a quantum chip capability with the University of California at Santa Barbara. So you got an old school tech company with some surfers from Santa Barbara. Somehow they're leading the next tech revolution. I'll believe it when I see it, but I'm hearing much more about quantum computing and the bulls on quantum computing making the case that it will be a big deal and it will be monetizable, and these stocks will run not in decades from now, but within the next 10 years. This is interesting to me. Biden was going to have export controls on semiconductors that were going to go into effect on May 15th. This was called the AI diffusion rule. And because that's next week, Trump has come in and said that ain't happening. No surprise, but that was a real potential threat to these semiconductor companies. And now, at least for now, Trump can change his mind at any moment. But now, at least for now, no AI diffusion rule from the Biden administration will be implemented on May 15th. I'm always looking for more AI use cases. United Health, which is one of the biggest stocks in the Dow Jones Industrial Average, the major healthcare insurance company, claims that they already have 1,000 AI use cases within their enterprise. So we'll see what happens. But remember, we've spent a hell of a lot of money building the AI infrastructure. Now we need to see the payoff. And I never thought 2025 was going to be much of a payoff year. I don't expect to see most of the goodies from AI until 2026. So the other thing that is interesting is there has been a rule that really impacts the Chinese retailers like Temu and Shein, that you could ship to the US, and as long as the product was less than $800, you could avoid the expenses associated with it. Well, no surprise, they called that the de minimis provision, that Trump has reversed that. And so now, even for these small sales, they're going to have to face the US tariff bite. And with that in mind, Temu has stopped delivering directly to the United States. Now they're trying to go through third country intermediaries, but that is an example. The prohibition on the de minimis exemption is essentially driven one of China's biggest e-retailers out of the US market, not lessening the US market, out of it almost entirely. Everybody saw that Trump was at it again with a 100% tariff on foreign films. That is very interesting because now we're getting into the realm of intellectual property and not just tariffs on goods. I do think this is another salvo. It could be interesting. I don't know how you could possibly do calculations to even calculate this tariff. But yes, another entree into this space, and we'll see what happens. Maybe it was just a kind of a bluster announcement to put some of our allies and other trading partners back on their heels, but a 100% tariff on foreign-made movies. And so, you guys, I have been on this buyer strike, as you know. I am starting to feel better about various names and technology. And so not across the board, but on a select few that are in green on my buy list that you see every Tuesday in this presentation, I'm starting to get back in. Not because I think the Trump tariff madness will end anytime soon, but we've seen that when it triggers a big drop in stocks or a big increase in interest rates, that Trump comes in, reverses himself, at least to a certain degree, and the market rallies. So it looks like we have the Trump put to make sure that the market doesn't go down too far, too fast, because his words will turn this around, and he seems to be willing to play that game. So before we log off here, does anybody have any questions? Okay, thanks for your question. All of these AI companies are about to launch browsers. How detrimental is that to Google's fading hold on search and browser? Does Alphabet survive antitrust? Yes, I appreciate the question. You're obviously a smart dude. I'm thinking about the same stuff. Yes, I do think folks like Perplexity AI are going to take some share. And I put my money where my mouth is. Perplexity AI has hired me to do some financial commentary. Why not? We'll see what happens, but I believe in it. And so I am worried about a continued slowdown in digital ad revenue driven by search over at Alphabet. So they're going to have to come back, right? They have Gemini, they have other things going on. The company has the deepest pockets of almost any company on the planet Earth. So they can do things either through their own development or they can make acquisitions without really denting at all their balance sheet. I think they see the urgency, and I think they will do some things dramatically. And at the risk of being disrupted, they should do something dramatically pretty urgently. So I have the same vibe that you're sharing here. In the antitrust, I think at the end of the day, no matter what happens, that the feds may force Alphabet to spin off YouTube, maybe even spin off some of their digital ad tools and digital ad tool platform. And I don't know if that necessarily freaks me out, because if I'm a Alphabet shareholder and I get stub pieces of all these spinoffs, they actually, as far as trading in the markets, may make me more money in separate pieces as they do when they were combined. So I don't worry so much about your second question, but oh man, I am worried about disruption of their search ad business for sure. Paul, any opinions on Boeing? Yeah, I've had Boeing in this portfolio before. I sold my Boeing pretty quickly when we got whiff of these tariffs, with the belief that, not a belief, I know it for a fact, that there is no bigger exporter in the United States, and we don't export much. That's why we have this problem. But there's no bigger exporter in the United States than Boeing. And so I thought, oh my God, since they're going to get absolutely smacked by these tariffs, I got out. And so even though I had a nice long-term gain in the stock, I've been out of it for a while. Now I'm kind of kicking myself in the ass because, as you know, it's come roaring back. And as you mentioned right here in your question, they've been getting some pretty big orders, despite the disruptions in the geopolitical situation. So what I would do if you have Boeing is, I still worry about tariffs over time. But if you have Boeing, I would not add to the position. I just hold what you got. And if you don't have Boeing yet, I would wait for a dip. Which company do you think are closest to jump in quantum computing? IBM is there. IBM already claims that they have $1 billion of quantum associated revenue per year. I don't know how they calculate that, but I think, and this kind of dovetails with the previous question, I think if Alphabet plays its cards right, this could be their accelerator, right? Having an entree into quantum before others, even as their search advertising business slows. So I think at least today, you're going to have emerging startups with new technologies. You always do. But I think today the best large caps that are positioned are IBM and Alphabet. And it'll be super important for Alphabet to get this right, because this may save the disruption that they're seeing in their search ad biz. All the power names, mostly good. I've owned all these names, not NRG, but the three others, CEG, TLN, and Vistra. I think that particularly Alphabet has announced, they need even more nukes. I still think, and we saw this, that when the AI infrastructure trade peaks, now some of those stocks have gone down and have come back since, But when we first saw these stocks getting blasted a couple of months ago, I mean, they went down hard, right? They went down really hard. So now I'm a little bit concerned that they're not going to be, essentially diversification plays. These are like the NASDAQ on steroids. So what I would do is, maybe pick one of those. I don't have any favorite right now, but did not essentially have that big of a exposure to these names in your portfolio, because these are super risky stocks. And we've already seen it play out in a very bad way in the last couple of months. All right, I'll take one last one here. What do you think about Reddit? Its growth potential is huge. First of all, I agree with the last piece. I thought Reddit was not a sham, but I was not bullish on it. Remember when they came public? I think I might have even talked about it on this program, but they have proven me wrong. And so, yeah, I think that, if you get a chance to buy it on the dip, I haven't been in the name for quite a while. It's been a while, but I think I might come back to it. And I must say, fundamentally, can't talk about the valuation, but fundamentally, I have been pleasantly surprised. So yeah, I support that. I do think their potential is pretty big. So with that, thanks for your questions. I look forward to seeing you next Tuesday. I'm easily found in the interim, but stay tuned. My big read for next week is I'm waiting for CrowdStrike to report on Wednesday. Anyway, best wishes. We'll see you again.